everybody. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. Markets are relatively flat today. Russell 2000 is up 0.4%. S&P 500 is down 0.1%. Crude oil is at $62 per barrel. Treasury yields are up slightly. 30-year Treasury yield is up 1 basis point to 4.94. 10-year is at 4.34. Friday is Powell's speech. That's going to be super important. Give me 1 second. All right, sorry about that. Okay, Powell's speech is on Friday. Let's look at the economic data that's going to come out today. We had the NAHB Housing Market Index. We're going to talk about that a little bit. Housing starts on building permits tomorrow. NBA mortgage applications, FOMC minutes on Wednesday. And on Thursday, we have the initial claims, continuing claims, Philadelphia Fed Index, S&P Global, Manufacturing Services PMI, existing home sales, and on Friday is Powell's speech. Let's look at the S&P 500 map. Palantir is down 2%. Meta is down 2.5%. Tesla is up 1%. Everything else is pretty much mixed. United Healthcare is down. It's up another 2.6%. It's been running up on news that Berkshire Hathaway has taken a stake. And everything else pretty much mixed. Let's look at the article. Wall Street muted as investors focus on retail earnings. Jackson Hole Summit. Wall Street's main indices were subdued on Monday in a quiet start to a week packed with corporate earnings reports from major retailers and the Federal Reserve's annual symposium in Jackson Hole. Investors also remained wary ahead of a meeting between U.S. President Donald Trump and Ukraine's Zelensky on Kiev's conflict with Moscow. Trump has told Ukraine to give up hopes of getting back annexed Crimea or joining NATO, but will push for a peace deal with Russia. Wall Street's main indices rallied over the past 2 weeks, with the blue chip Dow Jones hitting an intraday record high on Friday, aided by interest rate cut expectations and a better than expected earnings season, despite an uncertain trade environment. Investors will closely monitor reports from Walmart, Home Depot, and Target, among others, which are expected this week, to determine how trade uncertainty and inflation expectations have affected U.S. consumers. Data on Friday showed that while retail sales were increasing broadly as anticipated, consumer sentiment overall has taken a hit from mounting inflation fears. A lot of orders were pulled forward from a lot of retailers and companies that are producing products. So from an earnings standpoint, most likely they're going to be in line, and if there's a beat, it might be slight, said a head trader at U.S. Global Investors. 7 of the 11 U.S. S&P 500 sectors edged up, with healthcare stocks leading with a 0.5% rise. United Health and gained 2.3%, building on its nearly 12% jump in the previous session. Investors continue to price in a 25 basis point cut from the Federal Reserve next month, although they have lowered their expectations for another rate cut this year. Recent data have also suggested that while U.S. tariffs have not filtered into headline consumer prices yet, weakness in the jobs market could nudge in the central bank to take a more dovish stance. Markets hope that the Fed's Jackson Hole, Wyoming conference between August 21 and 2023, where Chair Jerome Powell is expected to speak, could offer more clarity on the economic outlook and the central bank's policy framework. My guess is that don't hold your breath. I don't think it's going to provide much of a clarity, but I guess we'll see. On the trade front, the Trump administration widened the reach of its 50% tariffs on steel and aluminum imports by adding hundreds of derivative products to the list of goods subject to the levies. Dayforce surged most in the S&P 500 index, up 25% after a report said PE firm Thoma Bravo is in talks to acquire the HR management software firm. Solar stocks such as Sunrun jumped 7%, and First Solar gained 6% after the U.S. Treasury Department unveiled a new federal tax subsidy rules for solar and wind projects. Interesting. All right, let's move on to retail earnings. That may give us some color on the economy this week. Retail earnings, what to expect from 3 key categories. Let's see. We're going to skip this one for now. Let's look at the home builder sentiment. Sentiment dips back to lowest levels since late 2022. A gauge of U.S. homebuilder sentiment fell unexpectedly in August, slipping back to its lowest level in more than 2.5 years, with more than a third of residential construction firms cutting prices and roughly two-thirds of them offering some form of incentive to lure buyers sidelines by still high mortgage rates and economic concerns. That's a one full fucking sentence. That's like a whole paragraph. Basically, incentives are rising. The National Association of Home Builder Wells Fargo Housing Market Index fell 32, matching the lowest reading since December 2022, from 33 in July. The association said on Monday. Economists polled by Reuters has expected the sentiment score to improve to 34. NAHB's measure of current sales conditions declined, and an index tracking future sales expectations was unchanged. Buyer foot traffic, though, edged up to its highest level since May, though it remains at a low level. On a regional basis, sentiment among builders in the Northeast skidded to its lowest level since January 2023, while it was unchanged in the South and Midwest and modestly improved in the West. Affordability continues to be the top challenge for the housing market, and buyers are waiting for mortgage rates to drop to move forward, said NHB chairman. Builders are also grappling with supply-side headwinds, including ongoing frustrations with regulatory policies connected to developing land and building homes. Mortgage interest rates have shown recent signs of easing amid expectations the Federal Reserve will resume its interest rate cuts at a policy meeting next month. The average rate on 30-year fixed slipped to 6.58% last week, the lowest level since October. According to data from Freddie Mac, rates have fallen nearly half a percentage point since the start of the year. Given the slowing housing market and other recent economic data, the Fed's Monetary Policy Committee should return to lowering the federal funds rate, which will reduce finance, an AHP chief economist said. The use of price and other incentives remains high, with 37% of builders cutting prices by an average of 5%, while 66% offered some sort of a sales incentive, the highest percentage in the post-COVID-19 era. 66% offered some sort of sales incentive, the highest percentage in the post-COVID-19 era. On Tuesday, the Census Bureau due to report, we already talked about that. Single-family housing starts fell to an 11-month low, and permits for new homes plunged to the lowest level in more than 2 years. Okay. Goldman Sachs economics team, more job report weakness is coming. This is I thought this was an interesting take. So let's read through this. The slowdown in the U.S. job market isn't over, and it may get worse. That's the warning from Goldman Sachs economists, who said hiring momentum has weakened more than previously thought. Revisions to earlier data suggest payroll growth is running at levels too low to sustain full employment. Our estimate of trend job growth is now clearly below even that low bar at 30,000 per month, Goldman Sachs economics analyst wrote. Future revisions to job growth are more likely to be negative, they said, citing weakness in areas like healthcare payrolls, seasonal hiring, and the way government models account for new businesses. The sobering outlook came just days after President Trump criticized the bank's team on Truth Social for being wrong about past market calls and too negative about the economy. The message contrasts with the relatively steady unemployment rate, which has hovered near 4%. But while joblessness does not show major cracks, other measures are flashing yellow, Goldman Sachs said. Labor force participation has slipped, job openings have started falling, and hiring outside of a handful of industries has slowed to nearly zero. That weakness matters for both the Federal Reserve and the White House. For the Fed, slowing payrolls strengthen the case for cutting interest rates to support growth. Goldman Sachs expects 3/4-point cuts this year in September, October, and December, with potentially 2 more in 2026 if hiring stays soft. For Trump, who has previously touted strong job creation as evidence of his economic record, any further cooling would undercut one of his key talking points. The Goldman Sachs team also pointed to structural shifts weighing on employment. Immigration has fallen sharply, which means the economy needs fewer new jobs each month to maintain full employment. Tighter immigration policies also suggest immigrant workers are less likely to work or be captured in official data. Interesting choice of words. But the slowdown appears more severe than immigration issues. Sectors like healthcare and education, which had been adding jobs via catch-up hiring to compensate for pandemic-related understaffing, are no longer seeing significant growth. This has contributed to a general weakness in job creation. Other sectors, including technology, manufacturing, and retail, could also face labor force headwinds in the coming months, the Goldman Sachs noted. Even modest additional softening could have outsized consequences. With the labor market already at the edge of what economists consider maximum employment, a low turnover environment could make it harder for unemployed workers and new graduates to break in. That dynamic risks locking out parts of the labor force, even if unemployment doesn't surge, the analysts added. Okay, all makes sense. Eli Lilly. So this was an interesting headline. I haven't read the article. Let's see what it says. I haven't really heard about this one before. And I don't know why someone would do this now. Eli Lilly taps high grade market with rare 40-year paper. Eli Lilly is tapping the U.S. investment grade debt market with a deal that's expected to include a 40-year bond, a rarity in a world characterized by high borrowing costs. The drug maker is selling debt in as many as 7 parts, with initial price discussions for the 40-year tranche at 1.05 percentage points above treasuries, according to a person familiar with the matter. 30-year is at 5%. So this would be just above 6%, I guess. The deal is also expected to include a 30-year portion, as well as others with maturities ranging from 3 years to 10 years, the person said, asking not to be identified, discussing private deals. The offering comes amid a dearth of supply of long-dated corporate bonds. Just 11% of high-grade debt sold this year had a maturity of 30 years or more, down from 15% in 2024, as companies have been reticent to lock in elevated borrowing costs for long periods of time. Eli Lilly is one of 9 companies selling U.S. high-grade debt on Monday, with McDonald's, Marriott, and Charter Communications among the others. Borrowers are piling in ahead of a seasonal slowdown later this month. They're also taking advantage of more favorable funding conditions. Yields this month are sitting consistently below 5% for the first time this year, yet demand continues to be robust. Most recently, investment grade order books grew to more than 5 times the size of fresh supply on Monday, while borrowers paid just 2 basis points in new issue concessions, both better than average so far this year. Citigroup, Goldman, JP Morgan, Mizuho, and Morgan Stanley are managing Eli's sale, with proceeds earmarked for general corporate purposes. The bonds are expected to be rated AA3 by Moody's and A+ by S&P Global Ratings. Interesting. Couple of Tesla news, and then we're going to call it a day. Tesla almost halves the UK monthly lease fee as sales slump, the Times reports. British Motors can now lease a Tesla electric vehicle for just over half of what they would have paid a year ago, the Times reported on Monday, citing industry sources. Tesla has been forced to offer discounts of up to 40% to car leasing companies to shift more units, the report said. The discounts are also due to lack of storage space for Tesla vehicles in the UK. Oh my God, the report said. Reuters couldn't immediately confirm the report. Tesla did not immediately respond. Tesla's July sales in the UK fell about 60% to 987 points in July, versus British new car registrations overall fell about 5% year over year in July. That's wild. And it looks like the BEV market share increased actually from 23.5 to 23. Oh, it's slightly up from the forecast to 23.8. That's crazy. In UK, like they're not really that. I wonder why Tesla sales in the UK are dropping versus Germany or France, where people are a bit more leftist, I think. Okay. Next one, I thought this was interesting. I haven't really seen it posted by any of the biased influencers, but startups Level 4 car. This is a new startup that kind of just came out of stealth mode. Level 4 car draws on China experience, but it won't be driving itself anywhere just yet. Tensor, a startup from San Jose, California, announced a new vehicle capable of Level 4 autonomous driving. The Tensor Robocar, equipped with over 100 sensors, is designed for personal and private ownership and is intended to be sold in the Middle East, Europe, and the US by the end of 2026. However, current laws on vehicle infrastructure limit Level 4 operation, making it unlikely to be fully autonomous anytime soon. Here's the car, the design, I guess. Let's read the article, because one of the reasons why Tesla's autonomous driving efforts catch a bit more attention is because it's available for personal ownership, whereas Waymo don't sell, even though they said that they might later on. But let's see what this startup is about. A new challenger to Tesla and Waymo's self-driving vehicle efforts was announced today. Tensor, an upstart from San Jose, California, claims to have a new vehicle capable of advanced level 4 autonomous driving that it hopes to start selling in the Middle East, Europe, and the US by the end of next year. Though technically an upstart, Tensor actually launched in 2016 and spent several years in China, known back then as ODX. A company spokesperson explained to CarBuzz that its core operations have always been California and that all ODX operations in China have since been divested, with all offices closed and the brand's China operations fully discontinued. Tensor is now solely an American company with no active presence operations in China. It's unclear how much research and development in the new car, known simply as the Tensor Robocar, is drawn from ODX's former China operations. Previous reports confirm ODX conducted extensive driverless vehicle testing in China. Here's the car again. Lots of LiDARs. Tensor's new vehicle is creatively dubbed the Robocar, equipped with over 100 sensors to allegedly be capable of level 4 autonomy. NHTSA defines level 4 capability as when engaged, the system is fully responsible for driving tasks within limited service areas and that human driver is not needed to operate the vehicle. The company mentions it can be calibrated to over other levels of autonomy, and it also comes equipped with a foldable steering wheel and display for scenarios where a driver may want or need to take control. At this stage, the vehicle is intended for personal and private ownership, according to the company's positioning. The website mentions self-driving operation in zones, but admits that outside of these designated zones, the driver will just take the wheel or switch to assisted driving for a smooth handoff between autonomy and control. All the vehicle systems are controlled by a central AI computer with components from NVIDIA. The website lists a veritable warehouse of technical components used by the car, including 37 cameras, Jesus fucking Christ, 5 LiDARs, 11 radars, 22 micro... Okay. All right. On that note, thank you very much, everybody, and I'll chat with you all next time. Take care.